In this video, we are going to talk about the dividend discount model and how it can be used to find a firm's intrinsic value. Dividend discount model is a fundamental tool for valuing a company. This model equates the value of a company's equity with the present value of all future dividends. With an equity instrument, dividends can be viewed similar to coupon payments on debt securities. That is, dividends are expected future payoffs to investors. From the perspective of a shareholder who buys and holds a share of stock, cash flows he or she will obtain are dividends paid on it and the market price of the share when he or she sells it. The future selling price should in turn reflect expectations about dividends subsequent to the sale. If an investor wishes to buy a stock and hold it for 1 year, the value of that share of stock is the present value of expected dividend to be received on that stock over the next year, plus the present value of expected selling price in 1 year. Well, let's look at an example. Suppose you expect a company to pay 58 cents in dividends next year, and you expect the price of the stock to be $27 in 1 year. Assume the required rate of return on the stock is 9%. Let's estimate the value of the stock. Well, discounting the expected dividend of 58 cents and the expected sale price of $27 at the required rate of return of 9%, we obtain $25.30 as the value of the firm. Well, similarly, if an investor plans to hold the stock for 2 years, the value of the stock is the present value of expected dividends in year 1, plus the present value of expected dividends in year 2, plus the present value of expected selling price at the end of year 2. Similarly, we can extend this argument to n periods. The value of stock is the present value of expected dividends for n periods plus the present value of expected price at the end of period n. Well, let's look at another example. For the next 5 years, the annual dividend of a stock are expected to be $2, $2.10, $2.20, $3.50, and $3.75. In addition, the stock price is expected to be $1.40 in 5 years. If the required rate of return on equity is 10%, let's find the value of the stock. The present value of expected future cash flows can be written as follows. The 5 dividends have a total present value of $9.92, and the terminal stock value has a present value of $24.84. If we add the two numbers together, we get the total value of the stock to be $34.76. As we extend the holding period to indefinite future, the stock's value is the present value of all expected future dividends. Even from the perspective of an investor with a finite investment horizon, the value of the stock depends on all future dividends. For that individual, stock value today depends directly on the dividends the investor expects to receive before the stock is sold, and indirectly on the expected dividends after the stock is sold, because the future dividends determine the expected selling price. In practice, of course, analysts cannot make detailed individual forecast of an indefinite number of dividends, and hence, in order to use dividend discount model, the forecasting problem must be simplified. We will now discuss 2 broad approaches to deal with this problem. The first approach is to use Garden growth model, in which we assume a constant growth forever. The second approach is to forecast a finite number of dividends individually up to a terminal value, and then finding the terminal value of the firm using Garden growth model. Let's talk about the first approach. The Garden growth model is one of the most widely recognized models in the field of security analysis and is given by the following equation. Here R is the expected rate of return on equity and G is the expected long-term growth rate in dividends. To illustrate the calculation, let's look at an example. Suppose that an annual dividend of $5 has just been paid. So basically D0 in the formula is $5. The expected long-term growth rate is 5% and the required rate of return on equity is 8%. Applying these numbers to the Garden growth model, we basically find the value of the firm to be $175. A word of caution, when calculating the model value, be careful to use D1 and not D0 in the numerator, which is the common mistake I see in the student solutions for the exam problems and even for the homework problems. So make sure you understand that when you calculate the model value, you need to use D1 instead of D0 in the numerator. Garden growth model is very simple, but it may not be realistic for many or even most companies. Many publicly traded companies experience varying growth rates depending on their life cycle. For example, in a growth phase, a company enjoys an abnormally high growth rate in earnings per share, and this could be called supernormal growth rate. While in mature phase, the company reaches an equilibrium in which such factors as earnings growth and the rate of return on equity stabilizes at levels that can be sustained long term. So a more realistic valuation model to use will be a two-stage dividend discount model. In this model, we start by forecasting dividends at supernormal growth rate in the short term, and will assume the forecasted dividends will stabilize at some point in future, and after that the dividends will continue to grow at some constant rate. So we value a firm in two stages. The first stage is the present value of the forecasted dividend over the short term, and the second stage is the present value of the terminal value of the firm, assuming a constant growth rate for perpetuity. So basically in the last stage, or in the second stage, we use garden growth model to find the terminal value of the firm. Let's look at an example. Suppose Med Corporation is expecting to pay 92 cents in dividend per share for the next 3 years, after which the dividends will increase at the rate of 4% per year. To find the value of the firm, we use two-stage dividend discount model. In the first stage, we find the present value of the 3 years forecasted dividend, and in the second stage, we'll use garden growth model to find the present value of expected future dividends growing at 4% rate until perpetuity. Solving this problem, or putting the numbers in the equation, gives us $21.36 as the value of the firm. Two-stage dividend discount model is useful because many scenarios exist in which a company can achieve a supernormal growth rate for a few years, after which the growth rate falls to a more sustainable level. For example, a company may achieve supernormal growth rate through possession of a patent or first mover advantage, or another factor that provides a temporary lead in a specific marketplace. Subsequently, earnings will most likely descend to a level that is more consistent with competition and growth in the overall economy. While the dividend discount model has a wide applicability, it is really challenging to apply this model to value a non-dividend paying firm, because predicting the timing of the dividend initiation and the magnitude of future dividends without any prior dividend data, or specific about dividend policy to guide, the analysis is generally not practical. In upcoming videos, we'll learn how to apply a residual income model to value a non-dividend paying firm.